So the gold is the next thing I'm looking to add, and exactly in what form and how in my model portfolios across the board. That's something I was waiting for this print to figure out what I was going to do going forward. Then I'll own staples, utilities, energy, and healthcare. Your defensive sectors combined with cash, gold, and the long bond. I'm about to add 15% in gold, GLD. Of course, own some physical gold. And so for those of viewers out there that were thinking about buying gold, I think we're on the cusp of the breakout where gold can go up to 5,000. Gold move in the last market where you got more than a double from, say, 2007 to 2011. You could see a similar type move here, right? In that you have a 3 to 5 year period where once it breaks out previous highs, then it just takes off and we don't look back. Considering the amount of money we printed, okay, I have no idea why gold is not above 4,000 right now. All right, I mean the statistic of the number of dollars we printed since March of 2020, it's like 40% of all dollars or 50% of all dollars ever created, and it's not like it only happened in America. It's happened worldwide, and we still have the best balance sheet out of everyone else. So why hasn't gold worked? I think, and I'm hoping, as an owner of physical gold, that we see this breakout now, right? Because once it breaks out, then you start to get the momentum players behind it. All the gold bugs that disappeared in the last decade reappear, start pushing it. And so I think we are going to get a breakout, and if we do get a breakout, it'll tend to be meaningful. I think the dollar is getting near its peak. The dollar's rallied ahead, and once you see that dollar reversal, once gold gets above 2,000, you could really start to see it take off. I mean, it's basically been dead since 2011. I think that's going to change. We've seen a tremendous rally since October. I think you've probably seen a peak in the 10-year and the 30-year. We might see the front end. So the 6-month treasuries were at 4.8%, 4.7%, where the front end is more 4.25%, 4.30%, like the immediate front end. And then so I'd say the 10-year and 30-year, the long end of the curve, rallies hard this year as we enter a recessionary period in anticipation of the Fed cutting. So the difference between the 2's 10 years is inverted now. I don't know that exact number. Again, I'd have to look that up. But we have a 2's 30 years inverted. The 2's 30-year relationship is the bond market's expectation of inflation plus growth over the next 7 years. Why 7 years? Because you get a recession on average once every 6 years. So you combine the contraction that we're going to go through right now. We are at kind of one of the most inverted periods, and during those inverted periods, if you buy the long bond, as the front end's going to come down, it typically rallies because you have your short end up here, you have your long end up here, and what you have is both of them typically come down. And so I think a duration is going to work this year because last year, and historically, whenever you have a bad year in bonds, the next year is pretty good. So last year was the worst year for bonds on record. I can't see the Fed raising another 400 basis points this year like they did last year, or 500. So maybe we get another 100 or 125 basis points, but that's the front end. That's the Fed funds rate, not the 10-year, not the 30-year. So I own TLT. I think that's going to be a good trade this year, and it's going to work out along with gold. So we'll just use the last one. So gold performed extremely well in 2008. The S&P 500 was down 35%. TLT was up 34%. Okay, that is the long bond ETF. Historically, the defensive sectors have done very well. So XLP, which is consumer staples, XLV, which is healthcare, XLU, which is utilities. So these are the sectors I have exposure to. I had a lot of exposure to energy. I think it was 25% of my portfolio from January until November of last year. I'm at 15% in XLE. I'm going to be cutting that down simply because of the volatility on a risk-adjusted returns. But the expectation is that XLE and then energy is going to perform extraordinarily well when China leaves lockdown and they come back online, creating a real supply-demand problems. I'm not as bullish on energy as I was. I will own some of it, but from an equity standpoint, My major equity position will be XLP, so consumer staples. And historically, when that happens, if the government tries to spend more money to get out of it, I mean, this is the story of Latin America and a lot of failed currencies, is that once inflation gets out of control, it becomes very, very difficult to tame. Okay. And so that, I think for that reason and that reason alone, the Fed is likely to go overboard in their restrictive policy, knowing the dangers of inflation. You become a banana republic once your currency becomes worthless, right? And it's in this country, you have a very, very concentrated wealth at the top, which is my belief, what's showing up in the consumer spending numbers, right? That's the concentration of wealth has never been more concentrated, and they're spending a lot of money, and that's papering over a lot of the United States. And so, pre-COVID, it was 50% of the country didn't have $500 for an emergency. That number is north of 65% now. At what number do you think that needs to get to before you start seeing popular uprisings? It's probably high, and things probably need to get dire. But the fact that we're talking about this leads me to believe that the Fed's not going to cut as early as a lot of people would like, right? All the financial problems we have, exist in China, right? And like to a much higher degree. I mean, their currency outside their country is essentially monopoly money. If you're 16, 17% of world GDP, why are less than 1% of international SWIFT transactions conducted in your own currency? So the China faces off the world in US dollars, right? And there's a reason for that. It's because we are the reserve currency. They have a $1 trillion US dollar sovereign wealth fund, right? So until something better comes along, what's happened to the purchasing power of your US dollar? Now, this has been extraordinarily volatile in between. You've cut in half and then gone up by a factor of over 20. And now we're sitting at 17 or 18,000, but that's something like that, or not the euro, maybe some sort of petrol state-backed currency 50 or 100 years from now will be the new reserve currency for the world. I mean, those are problems for much smarter people to think about and figure out. I just think for the next decade or so, I can't see the US dollar not being the reserve currency. And now, our debt to GDP, we've gone from 1 to 1 to like 1.3 to 1. So at what point do we get to 3 to 1 like Japan? So these last 3 years of policy decision has cut, 50, 100, 200 years off the dollar's reserve currency status. So that, if let's just say it was going to last for another 200 years, maybe now it's only another 50 years, but it's coming. I hope that I'm not alive when it happens.